All right, today we are diving into a really fascinating and, honestly, pretty brutal business case. It's the story of a market monopoly that looked completely untouchable and then, well, its entire world just crumbled almost overnight. So, just to set the stage, imagine you're a market leader and you watch your stock price just absolutely crater. We're talking down 70% from its yearly high, a truly staggering collapse. So, this is the story of a company called DreamFolks Services. And the big question we're going to tackle is how on earth does a stable, super profitable business have its entire foundation just ripped out from under it, seemingly in the blink of an eye? But, to really get the fall, you first have to understand the kingdom. So let's rewind a bit, back to when DreamFolks was the undisputed king of airport lounges in India. They were basically running a monopoly. Their business model was, well, kind of brilliant in its simplicity. DreamFolks was what you call an aggregator. Now, they didn't own a single airport lounge, and they didn't issue a single credit card. What they did was position themselves as the essential middleman, the one absolutely indispensable link in the whole chain. So here's how it all worked. You've got banks and card companies, right? They want to offer lounge access as this cool premium perk. But instead of the headache of striking deals with dozens of different airports, they just paid DreamFolks. And for that fee, DreamFolks gave customers one single pass to a huge network of lounges. And of course, they took a nice, profitable cut from every single visit. And was this model effective? Oh, you better believe it. For years, domestic lounge access, just that one service, made up a whopping 90% of their entire business. It was basically a cash printing machine, all built on this one simple, powerful idea. Okay, so how does a fortress like that just get breached? Let's get to the tipping point, that moment when everything, and I mean everything, changed for DreamFolks. This crisis wasn't some slow burn, it was a full-on explosion. In the middle of 2025, the big lounge operators, the companies that actually own and run the physical lounges at the major airports, they just decided we're done. They tore up their contracts and just walked away from the partnership. And the consequence of that was absolutely devastating. It completely rewrote the value chain. All of a sudden, the airports and the banks realized they didn't actually need a middleman anymore. They just started dealing directly with each other, completely cutting DreamFolks out of an equation that they used to totally dominate. And this is the key point, the thing you really have to understand. This wasn't just a bad quarter or some temporary headwind they had to navigate. No, this was a fundamental, permanent break of their entire business model. The game had totally changed, and they weren't really a player anymore. So what happens when 90% of your business just evaporates? Let's take a look at the financial aftermath and, sift through the rubble of their old empire. You see, one of the company's biggest strengths was just how incredibly profitable it was. Because they didn't own any of the expensive lounges, it was an asset-light model. And that generated a fantastic return on capital employed, or ROCE, historically floating around 35%. Now, with their main revenue engine stalled out, that number is expected to completely fall off a cliff. But hold on, the story isn't quite over. The company isn't totally broken. See, they came into this crisis with two really important things going for them: almost zero debt and a nice, healthy pile of cash in the bank. So that gives them a lifeline, right? A fighting chance to reinvent themselves. But it is definitely a race against time. And that, of course, brings us to the biggest question for anyone looking at this company today. Can DreamFolks actually pull off a pivot? Can they build a totally new, viable business from the ashes of what they used to be? So their new strategy is a complete reinvention. They're pretty much abandoning the domestic lounge market they once owned, and instead, they're shifting focus to three totally new areas: getting into international lounge aggregation, expanding into India's railway lounges, and offering other kinds of premium travel services. Now, this pivot creates three very, very different potential futures. You've got the bear case, where they basically stagnate and fail to replace that lost business. Then there's a base case, which projects a kind of slow recovery. But then you have the bull case, which imagines a world where they execute perfectly and aggressively scale up these new ventures. I mean, the range of possible outcomes here is just massive. So, after weighing this catastrophic collapse against the potential for a huge comeback, what was the final call? Let's say you had 1,000 crores to invest. Would you put your money on DreamFolks? Well, first, let's look at the very powerful arguments against investing. Their core business isn't just damaged, it is gone. Their competitive advantage, that moat that protected them, it's been completely filled in. There is absolutely no guarantee these new businesses will work, and the risk of failure, it's incredibly high. And the final verdict from the investment committee in our source material, well, it was decisive. The investment was not approved. The risk involved in this pivot was just deemed too great, the challenges ahead too monumental to justify putting that much capital on the line. And that leaves us with the final question, the one that's so hard to answer. This whole story really just highlights the challenge of judging a situation like this. Is DreamFolks a falling knife? A company in a terminal decline that you should avoid at all costs? Or are we watching the very first chapter of what could be a great corporate comeback story? Only time will tell.